Welcome back to the Blackletter Podcast. We set out to create an entertaining and exciting podcast about law and business. Blackletter, the name, comes from the Gothic typeset. Over time, Blackletter became the only font that English law books were printed in. It made it harder for kind of the common person to understand what the English law books said. Blackletter came to represent something that was law, that was set in stone, that was sort of old and a well-settled fundamental principle of law. We're here to demystify Blackletter law. We're here to demystify things that happen in business and law and where those two meet. And I hope you have fun listening. Here we go. Welcome back to another episode of the Blackletter Podcast. With me again, Sharon Eaton and Wright Lewis, two absolute experts. If you've been listening to this series and you've already heard about how to prepare your company to go to market and the things you need to think about and getting out of your own way, which I think is kind of a summary of episode 1. And then you've heard about the process of selling your company, the 3 phases, what an LOI is, and things to look out for, and tricks of the trade during the process. And finally, we're going to talk about what everybody wants to know. What is your company worth? Where does that number in the LOI come from? And the number that you get paid come from? And how do you get paid that? And it's super fascinating to everyone because that's the whole reason you're selling your business is the money. We're not doing business for the joy of business. I mean, I hate to say it. I guess some of us love what we do. Ikigai, that Robert Garcia book about being centered and like loving what you do and being valued. But you still, if you're selling your business, you want the money. So Sharon, Wright, let's talk about the money, valuation. How does that work? Is every business worth some multiple of the revenue, or are there maybe other things that are involved in valuation?
Valuation is part art and part science. So you start with what industry are you in? If you are running a software as a service business, SaaS company,
right,
and you are rapidly growing, and you've got 3 and 4 year contracts that people are tied in, you might be able to sell as a percentage of revenue. That does happen sometimes. That is unusual. That is not the norm. Very often when people come to me and say, okay, how is my company be valued? Let me start off by telling you, Sharon, that I want at least a 7 multiple. What that means to me is that they've probably been on the golf course with their friend who just sold their company for a 6 multiple. And they know that their company is better than their friend's company, which got a 6 multiple, so I deserve a 7. Doesn't work that way. It depends upon the industry, it depends upon margins, it depends upon a lot of factors. Another is that I'll frequently get approached by business owners and say, I need to sell my company so it's $14 million after taxes. And what that means is that they've just been to their financial planner who told them how much money they need to have the lifestyle that they want after they sell their company. A good number to know.
Excellent.
Good number to know, not relevant to the value of your company. Your company might be higher, might be lower. So in order to look at it, you start off with the industry that you're in because there are norms in specific industries. The norm for a SaaS industry could be a multiple of revenue. If you are in, let's say, a GovCon or an ordinary services company, it could be a multiple of earnings. Unfortunately, true personal services firms like law firms or dentistry practices or things like that, where there is a specific human doing work for clients, those actually tend not to even be worth a multiple of earnings because the concern is that when you sell, then maybe the customers won't want to come back for the new dentist or the new lawyer. So it really does matter by industry. There's no every industry is like this. If somebody says every industry is, run for the hills. These are not people who know what they're talking about. But for most lower mid-market companies, let's assume that you're a services company, you're a manufacturing company, and you've got $10, $15 million of revenue, 30, 40, whatever the number might be. It's part art and part science. The most normal way of doing it is you look at the net income, and that net income gets converted into EBITDA, earnings before interest, taxes, depreciation, and amortization. And in some services companies, EBITDA will be pretty much equal to net income. In manufacturing companies, EBITDA might be a lot higher. So it really does vary on the industry and the company, as well as financing. If a company has a lot of debt and they're paying a lot of interest, that interest is going to get added back in for EBITDA. So the net income could be a lot lower than what that EBITDA would be. Great. That part's easy. Then the next part is a little bit more artsy, which is normalizations. What is the business owner running through their company that a new business owner wouldn't have to do? So hypothetically, you've got 4 cars, and they're not trucks that get used in the company. They're your personal vehicle that you're running through the company. Well, that can get normalized out. I've seen renovations on offices. I've seen renovations on homes. I've seen payroll for parents and children and all sorts of things that the buyer would not replicate. So those things get added back into the EBITDA to get to adjusted EBITDA. Now you have an adjusted EBITDA number. That part was the science part. Now comes the art part. And the art part is figuring what's the right multiple. And that goes by the industry that you're in and what your company looks like. Hypothetically, let's say that you've got $4 million of adjusted EBITDA. That's very, very nice. But each year on January 1st, you've got to rebuild your client list. You have no idea where that money's coming from. That company's going to get a lot lower multiple than a company that had long-term contracts and can predict what their revenue is going to be in 25 and 26. So there's a lot of factors that go into it. A low multiple would be 2 or 3, and there are definitely companies that get 2 or 3 multiples. Sometimes there might be 2 or 3 multiples and then earnouts on top of that. We could talk about that. Sometimes, if let's say you are in a cybersecurity firm and you're doing very high-end work and you've got long-term contracts, you might be able to get a 10 times multiple. So it really depends upon what industry you're in, what kind of work you're doing, the visibility of future revenue, how well the company is run, and whether or not there is a significant management team outside the ownership. Right? What's been your experience?
I don't often get too involved in the valuation discussions. The part of the valuation that we're involved with usually is two areas really, which is basically if a seller is willing to take a note for any significant amount of money, the chances that they get a higher valuation, I think, are better. If they want all cash at closing, there's probably some discount for that. And the reason being that, A, you're not getting, that they're not going to get interest. So when you incorporate the concept of they're going to have interest over 3, 5, 7 years on the seller note, ultimately your total purchase price is a lot higher. And there's also benefits for the seller to do that too, in terms of taxes and spreading the purchase price out over a longer period of time. But the seller note also gives the buyer a little bit more comfort. It's usually something that the buyer can set off against if there's indemnifiable, indemnification claims for breaches of reps and warranties by the seller. You may be able to get sort of higher total valuation by holding a seller note for a period of time rather than just taking all cash. The other area that we sometimes get involved with in trying to make deals work that may be falling apart, and Sharon actually mentioned it, was by implementing an earnout, right? And so if there are, if the buyer and seller are too far apart on what a reasonable valuation is, or what adjustments, or we had this one-time charge, well, we don't think it was one time. If you have those kinds of arguments about the future, essentially, we can just say, all right, well, we agree on what the current value, what we agree, here's the cash purchase price. And then, we're going to stay on and help make sure that we hit certain targets for, mainly for revenue, post closing. And if we do hit those targets and the company continues to grow or continues to make the same amount that it made during the pandemic, which was a huge time period where we were seeing lots and lots of earnouts, post pandemic purchases, if we do that, then we'll get an additional purchase price consideration based on hitting those targets. And it's one way that we sometimes are able to bridge the gap between parties who can't necessarily agree on valuation.
How does net working capital affect valuation or purchase price? Or I guess the better way to ask it is, how does net working capital affect the seller's perception of what the purchase price is? And I know that's a weird way to put it, but I know that net working capital is a sort of confusing concept, and we didn't touch on it yet. And I figured we could bring it up now since I think it kind of plays into this conceptually.
Sure. Let's talk a little bit about what net working capital is.
Okay.
Because sellers often have no understanding as to why are we talking about net working capital at all. Every business owner knows that you need to have some amount of liquidity to keep your
Right.
company running. If you have accounts receivable outstanding, but your payroll has to be paid tomorrow, you can't pay your people with your accounts receivable. They expect to have cash in their bank accounts. The net working capital is essentially the oil in the gears of the engine that makes your company function. That it becomes creaky if you don't have a certain amount of cash. And by cash, we're actually not always talking about cash. We could be talking about just value on the balance sheet. So hypothetically, you're looking at a balance sheet and there's AR, accounts receivable, and there's AP. And the amount of AP and AR will vary from month to month. But there's going to be certain norms in your company as to how much AR, how much AP, what's the difference between them. The difference between AR and AP, and it is essentially net working capital. The calculation is a little bit more complicated than that. I just want to say cash should not be included in net working capital. Very often on balance sheets, the seller will have cash. Cash should not be included at all. There are some current assets other than AR. There are some current liabilities other than AP. But your basic, those are the two big ones. And the seller needs to understand that they are selling a functioning company. They are not getting a discount of what the future revenues are going to be. They're going to get a multiple because it's an ongoing company. And part of it being an ongoing company is having the oil in the gears for the company to work.
In other words, you can't buy a car without oil because it just won't drive.
There you go.
Right.
That's exactly right.
I like this car metaphor.
You generally need to have a little bit of gas in the tank. You may not need to have a full tank, but you definitely need oil in the engine for it to work, unless you've got an electric car. At which time, that net working capital should neither be an increase nor a decrease to the purchase price. It's not an opportunity for the seller or the buyer to win more value.
Right.
It is simply, what does this company need in order to function for a limited period of time after that transaction?
Is an easier way to think of that as just your normal operating cash, your normal operating capital? I mean, net working capital is kind of your operating funds, right? If we look at it as the oil, it's what you use every month.
Yes. And sometimes the amount of net working capital turns out to be how much cash it takes to run the company for a month, but sometimes it's not. And when we're working on a deal, we're trying to have the seller hand over the balance sheet at closing, and that handing over the balance sheet provides sufficient net working capital to the buyer, that they don't need to leave anything other than that balance sheet. But I once turned to a client and said, listen, all the cash on the balance sheet is yours. You're going to hand over the balance sheet. Otherwise, so you AR, you're going to hand over, AP, you're going to hand over. And this client said, okay, I now understand. I'm going to go collect as much of my AR as I possibly can in the 2 or 3 weeks prior to closing. So where they normally had $2 or $3 million of AR, at closing they had 500,000. And I said, where's all your AR? They said, oh, it's in our cash, which we get to keep. I said, okay, you caught me in a misstatement. You get to keep the cash so long as you don't manipulate the process. It's not intended to screw the buyer, but it's also not intended to screw the seller. It's got to be
because the buyer
fair,
was counting on that AR. Yeah, the buyer was like, hey, this is the normal AR they carry. So gotcha. Okay, makes a lot of sense. Right? Anything to add to that for this conversation about valuation and net working capital?
Yeah, I mean, I just want to highlight the point there that Sharon made, that basically your multiple is based on your functioning company and all component parts of that functioning company, and that includes your net working capital. And if you were going to liquidate your company, you would be getting a much different purchase price for your assets. So I think when you're talking to, when we're talking to potential sellers, you need to understand that the multiple is contingent on having a reasonable amount of net working capital.
Awesome. Thank you guys so much. So I think that was super helpful, pretty succinct. I think just a little over 15 minutes, listeners. Thank you for listening. Check out, there are slides on net working capital underneath this audio, and there will be slides on the video that we will include for you guys. Download us where you get your podcasts and check in. I think we've got one more show to do, guys, on like the little things, maybe like a short show on due diligence, reps and warranties, key terms in the deal. Anything? Do you think we can cover that in one more quick show? All right, we'll do. So check out episode 4, which is coming up right after this with Sharon and Wright. We'll see you back here on the Blackletter Podcast. That's all for today's episode of Blackletter. Thanks again for listening. Join us next time when we talk about more Blackletter issues in creative ways. Make sure you subscribe to the podcast so you never miss an episode, and check out our website at blackletterstudios.com.